What does it look like?
Well, these numbers are disappointing actually, Mangalam. You know, if these are the numbers and this is no one-off, because there is a benefit that they've got of lower power and fuel cost, but that margin that was flashing on the screen, well, that's a bit of a disappointment. I'll tell you what, you know, there's no cooling off on the freight and forwarding expenditure, not much at least out there. On the power and fuel cost, there has been some decline, but maybe the street was anticipating a little bit more of a decline out there. And what's gone up actually on a year-on-year basis is the other expenditure. So we'll require some clarity on that front. This margin number for the time being, that's a little bit worrying, because the top line is pat in line with what we are working with. We're waiting for the volume number. To give you a sense, we are working with volume growth of close to around 5.5 to 6% approximately, which is more or less in line with what the street was working with, but we're expecting pricing to remain weak. So just trying to get out further details on that front. There is some cooling off on power and fuel costs, but we'll have to wait for further details. I think we have got operations. Yes, domestic sales volume growth is around 6%. So no worry on the top line. Energy costs actually are lower by close to 17% on a year-on-year basis because of the reduction in fuel cost. But the raw material costs, they rose by close to around 1%. That's attributable to the increase in cost of fly ash. So, you know, that's the key reason why, in fact, these numbers could be a little bit softer. Volume growth in line. Maybe the realizations were under pressure, but it appears it's as much as expected. And maybe they have not got that benefit in terms of operating leverage on the raw material costs, which explains this miss out there. But let's get in.